It is a welcome bounce. I think, overbought conditions have returned for really all of the mega caps. Meta, for one, is right up against its downtrending 200-day moving average. So there are resistance levels in line. There are also downtrends still very much intact there. So while we don't have any decisive sell signals coming into these earnings reports, I think when you see the overbought reading ahead of them, it does make it harder, essentially, for them to see upside follow through. So they're somewhat challenged here coming into resistance. The leadership has been quite good. That's affected market sentiment. It's affected sentiment in a way that is actually not constructive from a contrarian perspective. We still watch the volatility index, or VIX, as an indication of transactional sentiment, and it's very depressed, showing some complacency. So we worry a little bit about that, especially in an environment that has an overbought breadth reading. Breadth has been widely noted as being very strong. This is true, even if the mega caps exhibited leadership. And yet those measures are quite overbought and haven't reversed course fully, in our opinion. So we're a little bit nervous about the reactions here. We'll watch and wait, not willing to step in front of them. But we do think there's something to prove from the market right now. Just in January, this is as of really yesterday's close with the January monthly data, we did see something interesting, though, that's brand new, and it's a DeMark signal, so one of these counter trend indicators that we track in 10-year Treasury yields. So that's something that would suggest that this year is indeed an inflection year. So we obviously don't think necessarily that we have that inflection already. And yet I think that would be one indication that yields should actually be more range bound for several months. And that's a shift in our work. Long-term momentum is still to the upside there, but should start to neutralize here based on that signal.
Interesting. And so if we do, for whatever reason, whether it's the Fed or just because we are somewhat overbought in the equity indexes, if we get a pullback, what would you be looking for to frame whether that's just kind of a normal routine, helpful pullback, or something that compromises, where this rally might end up?
The worst case scenario, I think, for the market would be a grind lower from here as opposed to something sharp. When you see sharp moves, they're usually counter trend. And in fact, that's why we're a little bit worried about the sharp nature of some of the up moves in the likes of Bitcoin and other higher growth areas of the market. Those fast and furious rallies are usually counter trend. What we really want to see is more of that slow grind higher. So if we saw the major indices roll over and just start to grind lower, that would be worst case in our opinion. Initial support for the S&P 500 is roughly 3880 now, based on that same cloud model on the daily chart. So that's sort of a good breaking point in our opinion to suggest that if it breaks, then we'll go back to those October lows.
All right, so that's a little less than 5% pullback from here would be that support level. Katie, thanks so much. Talk to you soon.
Of course.